Hey everyone, welcome back. I'm Andrew Meet Rich, and today we've got a packed episode. We're talking about signals flashing in the crypto market that almost nobody is reading correctly. We're looking at gold and silver doing very different things right now, and why Wall Street's sudden love affair with gold should make you pay attention. We've got a veteran investor, 42 years in the game, declaring a political movement finished, and the numbers behind that verdict. There's $175 billion in tariff money that the government collected and now seems to have conveniently forgotten about. And then, saved for the very end, a story about India that reveals how the entire concept of strategic independence can be, well, a beautifully packaged illusion. If any of that sounds interesting to you, do me a favor, hit that like button, subscribe if you haven't already. And if you really want to support what we do here, consider using the Super Thanks feature or becoming a channel sponsor. I say this because, look, every episode takes serious research, serious fact-checking. We're not here to recycle headlines or spread noise. We're here to cut through it. And that takes time, resources, effort. Your support genuinely makes this possible. Now stick around, because what I've saved for the end of this episode, honestly, it might change how you think about one of the world's largest democracies. All right, let's start with crypto. Bitcoin is sitting around $66,000 right now, and on the daily chart, it's forming what technical analysts call a classic bullish flag, the breakout level, 69,000. If it punches through that, the target range opens up to 80,000, maybe 85,000. Now, the invalidation, the level where this whole scenario falls apart, that's a confirmed close below 60,000. If that happens, you're looking at a slide toward 52, 53,000. But here's the thing that really caught my eye. And if you've been watching markets long enough, you'll know why this matters. 9 out of 10 commentators right now are bearish on crypto. 9 out of 10. They're screaming that crypto is finished, that it's over, pack it up. Historically, and I mean this with data behind it, not just gut feeling, that kind of extreme bearish consensus is one of the strongest contrarian indicators you can find. When almost everyone agrees on the direction, the market tends to do the exact opposite. It's not magic. It's crowd psychology meeting liquidity. So while the chorus is singing the funeral song, the charts are quietly whispering something very different. And it's not just Bitcoin. Altcoins are forming bullish patterns too. Avalanche is shaping up. Polkadot jumped 13.5% in a single day. Solana has a target of $120 if it breaks through the $85 to $86 resistance. Chainlink climbed 7% in one session. Ethereum is bumping against resistance around $965, and it needs to break through that descending trend line to confirm any real reversal. But the setup across the board, it's there. Now, I want to be careful here because setups are not guarantees. They're probabilities. And that distinction matters more than most people realize. All right, let's shift to precious metals. And this is where things get interesting because gold and silver are telling two very different stories right now. Silver is trading in a range between $70 and $92 per ounce, stuck in a sideways consolidation pattern. And statistically, about 75% of these kinds of patterns resolve to the downside. Resistance sits at 91 to 92, support at 70 to 71. It's trapped, honestly, caught between a floor and a ceiling, kind of like the economic policy that put it there in the first place. Gold, though, gold looks significantly better. It's broken through short-term resistance, and it's approaching the $5,400 zone. If it breaks through that, the target is $6,000. Support holds around 4,300 to 4,400. Both metals remain long-term bullish, but in the near term, silver is more vulnerable. And here's a principle I keep coming back to, one that separates people who survive markets from people who don't. Emotions are the enemy. Follow probabilities, not fear, not greed. Easier said than done, I know, but it's the only edge that actually works over time. Now here's where things get really fascinating. And if you're still on the fence about gold, this might shift your thinking. Central banks around the world have been buying gold aggressively for years now. But the real game changer, and most people miss this, is that the physical gold trade has migrated. It's moved out of London, out of COMEX, the paper markets, and into Asia, primarily Shanghai. And why does that matter? Because it stripped the manipulators of their primary tool for suppressing prices. The paper market was the lever, and that lever is weakening. Here's a perfect example. About 10 days ago, the bears had an ideal opportunity. Asian exchanges were closed for holidays. Perfect window to hammer gold down. And they tried. They managed a brief dip. By Friday, everything recovered, and then some. That tells you something about the underlying demand. It's not speculative froth, it's structural. And now, Wall Street. The same Wall Street that spent 40 years treating gold like a relic, like something your grandfather hoarded in the basement. For the first time, major banks are recommending gold as a standard portfolio allocation. Think about what that means. If gold allocation moves from 0.5% or 1% of portfolios to just 2 or 3%, the price doubles. And meanwhile, competition from crypto is actually weakening in some segments. Meme coins are imploding, NFTs are collapsing, parts of that market are self-destructing. Oh, and one more thing. There are claims in the Epstein files suggesting that the gold in Fort Knox, well, might not actually be there. Make of that what you will. But when even Wall Street, which dismissed gold for 4 decades, starts telling clients to buy it, that's not just a shift in sentiment. That's an acknowledgement that the paper system is cracking. Now, I want to share something with you that really stopped me in my tracks. An investor with 42 years of market experience, someone who, by the way, is married to a MAGA supporter, came out and said flatly, the movement is over. And before you dismiss that as political bias, hear the reasoning. Because it's rooted in numbers, not ideology. Trump made 2 critical errors. First, he went into the trade war swinging a big stick instead of extending an olive branch. Second, he bet everything on tariffs that turned out to be legally vulnerable. A year ago, he was in a honeymoon phase with voters. Now, the polls are turning against him. Democrats have a realistic shot at retaking at least the House of Representatives. And here's the deeper irony. Trump used the stock market as his scoreboard. Every rally was proof he was winning. But stock market gains, they helped maybe 2 or 3% of the wealthiest Americans. Everyone else was still struggling to make ends meet. His ego, according to this investor, is too large for retreat. So what does that mean? He's going to double down. Push harder on the same strategies even if the evidence says they're not working. The upcoming meeting with China's leader, don't expect a breakthrough. Trump simply doesn't have the cards for negotiation at this point. And by the way, if you think this is just about one party, let me disabuse you of that notion. Congressional corruption runs through both sides of the aisle. Insider trading is rampant. You've got members of Congress who arrive with nothing, and 5 years later they're worth $30 million. That kind of systemic rot is yet another reason people are running toward gold. If you're finding this valuable, drop a comment below. Let me know what you think about where this is all heading. Subscribe if you haven't. We're just getting to the good stuff. All right, here's a story that should make your blood boil, regardless of where you sit politically. After the Supreme Court ruled that Trump's emergency tariffs were unlawful, a massive question emerged. What happens to the $175 billion already collected from American importers? According to U.S. Customs data, by mid-December 2025, $133.5 billion had been collected. Economists at the University of Pennsylvania estimate the final total at $175 billion. Now, traditionally, when tariffs are struck down, the government returns the money. With interest, Treasury Secretary Scott Bessent publicly acknowledged the obligation to return these funds. That was the tone initially. But then something shifted. The Department of Justice went quiet. Customs issued no guidance, no instructions, nothing. Nearly 2,000 importers, including FedEx, have already filed lawsuits. But here's the part that really stings. Potentially 600,000 importers are owed money, and the vast majority of them are small and medium businesses. They don't have legal departments. They don't have the resources for prolonged court battles. Even in the best-case scenario, this process takes 12 to 18 months. Big corporations can absorb that weight. Small businesses, some of them will spend more on lawyers than they'll ever recover. And Trump's disapproval rating, it just hit 60%. When a government collects $175 billion through tariffs that were ruled unlawful and then conveniently develops amnesia about giving it back, that's not bureaucratic delay. That's a business model. And now, the story I told you I was saving. India. And I think this one is more revealing than anything else we've discussed today, because it exposes a contradiction at the heart of how nations actually operate versus how they present themselves. India is a net energy importer. Full stop. And that single fact shapes everything about its foreign policy. The Modi government is publicly pro-Israel and pro-American. That's the branding. But reality, as it tends to do, tells a different story. India is critically dependent on oil and gas from the Persian Gulf states. That dependency limits how far India can lean into its pro-Israel stance. At the same time, India cannot stop buying cheap Russian energy, and that limits how pro-American it can be. So what does India call this balancing act? Strategic autonomy. It sounds principled, doesn't it? Like a deliberate, philosophically grounded choice. But it's not. It's forced. India's non-alignment isn't driven by ideology. It's driven by material dependency. The choices aren't made in think tanks, they're made at the gas pump. And it gets more complicated. Iran could be an alternative energy supplier. But because of sanctions, India can't properly pay for Iranian energy. Iranian accounts in Indian banks are overflowing with rupees that Tehran literally cannot spend. There's a pipeline project, a so-called peace pipeline, from Iran's South Pars gas field running through Pakistan into India. It's been discussed for years. It remains completely blocked by the sanctions regime. When your strategic autonomy is determined not by your principles, but by who sells you oil, that's not autonomy. That's dependency wearing a diplomatic mask. And that, I think, is a pattern you'll see repeated across more and more nations as energy becomes the real currency of geopolitics. That's where we are right now. Crypto flashing signals the crowd refuses to see. Gold breaking free from decades of paper manipulation. A political movement running out of road. A government sitting on $175 billion it probably owes. And a nation caught between the image it projects and the reality it lives. None of these stories are finished. They're all still unfolding. And if you want to stay ahead of where they're going, make sure you're subscribed, because we'll be tracking every single one of them. Every episode you watch here is built from scratch, researched, verified, cross-checked against multiple sources, because that's what real journalism demands. No corporate sponsors telling us what to say. No editorial boards deciding what you're allowed to hear. Just honest work delivered straight to you. And if you believe that kind of independence matters, the simplest thing you can do right now is hit that like button and drop a comment. It sounds small, but YouTube's algorithm reads those signals. It pushes the video to more people. It expands the reach of what we're building together. If you want to go further, subscribing costs nothing, and it means you won't miss what's coming next. And for those of you who choose to support through super thanks or channel sponsorship, I want you to know that's not charity. That's a partnership. That's you saying this work has value, and I take that seriously. Every bit of support buys time to dig deeper, to verify one more source, to get the story right instead of getting it first. Share your thoughts below. Challenge what I've said, add what I've missed. This community gets stronger when you're part of the conversation. Thank you, sincerely, for being here.